quite a shift for somebody mentally to move from, buying a 40 Act fund that's invested in commodities or REITs or some other type of hard asset related to actually purchasing land and kind of then introducing all the components that come with land ownership.
Yes. Welcome to the Land and Everything Else podcast. Today, I'm really excited to be joined by Alan Hutchins. And Alan, I was wondering if you could introduce yourself.
Yeah, thank you very much. I'm a portfolio manager at Dimensional Fund Advisors these days. But to take it way back, I, native Texan here, grew up in Texas. I went to Texas Tech with you back in the day and spent a little bit of my early career in IT. I thought I was going to do technology all my life, and then eventually kind of tripped into the finance world, and that's where I've been living now for a good part of my life. Well,
we really appreciate talking with you today, and go Red Raiders, as we're both alumni from there. So on the Land and Everything Else podcast, we talk a little bit about the non-stock and bond side of investing. And I wanted to have just a conversation with you today. I know that part of what you do at DFA involves commodities management and also fixed income portfolio. And so how would you describe your role at DFA? And then we can kind of get into a little content.
Yeah, definitely. At Dimensional today, I wear a variety of hats. On a day-to-day basis, I'm managing some commodity strategies. So definitely involved in the commodity markets there. But as well working on our bond desk as well, so managing fixed income strategies across mutual funds, ETFs, and separate account vehicles. So that's probably the core of what I do, but I also work on technology still. So I spend quite a bit of time working on our technology vision for the team and fixed income and commodities generally, trying to understand how we as a portfolio management team and trading team can continue to adapt to the changing world around us. So
our first question will kind of pivot off that. When we look at the changing world around us and we look at commodities and commodities markets, if you go back maybe to COVID and then interest rates getting slashed and then where we are today, how have you seen commodities markets work in that space, and has it been different than traditional?
Yeah, definitely. As we went through the COVID, kind of even really the post-COVID period, of course, we saw, many imbalances kind of in that supply and demand metrics that, are very critical to the commodity market. But through all that time, I'd say we saw commodity markets continue to work. We continued to see transparency in the pricing. So we continued to see information reflected in those commodity prices as soon as that information was available. So we really continued to see commodity markets do what they've really done for the last 500 years, continue to take all those components and incorporate them into, not only today's spot price, but also as you look out the curve of commodity prices and see those work just as we'd really much expect them to.
And if we're in a world of interest rates softening, we'll see what happens there. But to that end, how does that kind of change your world and the investment space a little bit?
Yeah, no, definitely. Rates do have an impact across most asset classes, and really an underlying component as we look at those. From a commodity perspective, our approach is very systematic in nature. So we're going to continue to provide the same foundational exposure to commodities in our strategies. And continue to provide the systematic enhancements that we've built in commodities around how we position our commodity exposure. And then on the fixed income side, I know that's not what this podcast is about, but we don't necessarily forecast interest rates, but we take information in today's term structure and incorporate that into some of our duration positioning decisions.
If you could break for just the listener down a little bit, when we talk about commodities markets, if you could share a little more about the commodity types, asset classes that we're looking at there.
Yeah, and I'll probably speak a little bit more to the space that I'm playing in. The strategies that we offer will be predominantly kind of more liquid markets, exchange-driven markets. The strategies that we look at focus on 24 different commodities out of the Bloomberg Commodity Index today. And so that, those change from year to year as there's additions and deletions with that index. But we really focus on those liquid exchange-driven markets where we see ample liquidity, production. We see a good balance of the supply and demand side of the market. So enough participation that we feel like there's transparency in the prices of the markets that we're working in. And so it's really the part that we work in. There's as you kind of break that out, there's going to be energy, agricultural, precious industrial metals, as well as some softs in there. So a very, very diverse set of commodities as well. That's kind of one thing that we really believe in here at Dimensional is there is one free lunch, and it's diversification. So you'll see that across all of our strategies, a real focus towards not focusing on just one commodity, but rather a very well-diversified basket of commodities.
So I've got a couple of pivots off that, and thank you for sharing that space. When you look at the end user, right, who is then taking the product that you manage and investing, or, have we seen a trend from institutional family office advisor? Has that trend trickled down in your world, or has it always sort of been an advisor facing at Dimensional?
For Dimensional specifically, I'd say it's primarily been that more advisor focused type of relationship that we have to our commodity strategy. And I think that's important because you want to be able to put some communication around the role of commodities in a portfolio from the advisor's perspective, and then being able to understand and communicate and weather even through some of the storms and through some of the great times, how that commodity component's playing a role in the portfolio.
And when we look at a bigger, let's say, equity bond portfolio, and we're talking about diversification as a free lunch. Historically, how do we see, commodity markets and the way you manage when we look at an equity bond commodity portfolio? What are advantages of having that third asset class that maybe you don't get out of the first two?
Yeah, we see people approach commodities from a variety of different perspectives. Definitely see people that feel like it's a somewhat diversifier, an uncorrelated asset to those equity and bond assets in the portfolio. You see it also as maybe just a way to somewhat hedge against those changes in commodity prices in somebody's own life. Right. Funny story, when I was just graduated from college, I had actually inherited a natural gas well, or a portion of one, when I was a child. And so we'd moved to Iowa, my first job out of college, and the first winter in Iowa, those energy bills hit, and the prices were shocking, to survive the winter. But what I had was that natural gas check that would show up. And it was almost the perfect hedge some months. It was almost kind of ridiculous how close that was. And so for me personally, I kind of think of that as really a great prime example of how sometimes commodities could help an individual hedge against some of those different shocks in their own lives.
Oh, for sure. And to the extent of agriculture commodities, and I asked that coming from a college of ag and in a financial planning program, so hardly an expert there. But, to what extent, we hear in media about weather events, and we see temperature fluctuations, and then of course that naturally does impact agriculture, but agriculture is also very global, right? So you could have an incredible year in Brazil and Argentina, and maybe the Midwest not so much, but it balances out a little. To what extent do y'all pay attention to weather patterns, and is that something that has been big in ag with y'all, or is it? I'd just like to get your thoughts on that.
Yeah, I'd say definitely there are so many. I guess I'll back up just a little bit here and say there's so many different factors that play into commodity prices across the curve, whether it be just the seasonality of the crops themselves, weather, geopolitical events, tariffs. You could keep going down the list of all the different factors that play into that. Weather, of course, being a big one. Growing up on a farm, the weather was the most important part of the nightly news for us, knowing what was going to happen. Our approach at Dimensional, it takes a little bit of a step aside from trying to be predictive or trying to necessarily call shots on where we see maybe potentially trying to forecast where the markets are going. Our approach has been more to take academic research and research, that we've, vetted internally and try to find if there's systematic ways that we can position our strategies in order to take information in today's commodity prices in order to increase our expected return of our strategies. And so there's a few different ways we're doing that in our strategies today that we see, very reliable relationship between those prices that we see today and the information in those prices and ways we can extract future higher expected returns.
Well, you don't have to share how the magic happens in the 8 ball, but I think it's important to understand lots of information, academically guided. You're looking at reliable sources, and you're not necessarily saying we're going to predict the future. You're looking more at the current. So, I think that's great. You said growing up on a farm, and does that kind of impact and flavor where you wound up, where you are in your career right now? Do you think that has some element to it, or was that sort of a coincidence?
A little bit of both. I'd say as we were launching the commodity strategy here on the desk, definitely drew me a little bit closer to the launch of that. Due to a little bit more of the technical nature of the strategy itself, I was a little bit more well-positioned to work on it. So, yeah, it probably did. Definitely have an interest in the commodity markets and continuing to, not only watch the weather out on the family farms, but to also kind of understand prices in the broader global market and probably pay a little bit more attention to some of the cotton and wheat news rolling across the news blotter than other markets.
Well, yeah, that's the West Texas, and from that end, totally understand where you're coming from there. I also enjoy, thinking of back home, but I do wonder a little bit. We've talked a little bit about commodity pricing. We've talked a little bit about just having diversification and a free lunch. One thing that I've noticed is as more and more investment managers, when I started this business in the late 90s, it was very much A shares, active management. It's kind of the name of the game, right? And then as I saw that transition into more of a, what's the value in that? Maybe we have a more passive approach, and maybe having kind of a move towards passive than a move towards ETFs, and you've seen that in wealth management. But as we get more into non-traditional stock and bond investing, and maybe saying, okay, well, 80-20 works, but we could, build a portfolio with lower pairwise correlation if we throw, a commodities fund in or have some REITs in, or, things like that. To that end, you do see a little more active management again, right? Like on that end, and it feels a little cyclical. So I was wondering, to some extent, passive v active, where do you land on the commodities world? So I don't imagine you just go buy a bunch of corn and cross your fingers, right? Like that's not going to work there.
Yeah, no, definitely do not cross our fingers ever. And I think that's what I enjoy about working at Dimensional, since we are taking, that more systematic approach, that I've got the evidence in our research. And, my job is purely to implement that research.
Yes.
You really speak, probably kind of two questions in there. The first is more institutional type involvement in the markets, here specifically with commodities. It's something I often get questions of, or is this market too saturated with institutional investors to now start to damping out some of the premiums that maybe we've seen in the past? And we really haven't seen evidence of that. It's a very vibrant market with some very big commodity players.
Sure.
They're just getting bigger in the market, hedging their production, supply, very much downstream to that, all the way from the field to the tabletop on the agricultural side. On the dimensional side, we focus a lot on the shape of those commodity curves, looking at those on a curve by curve basis, looking if there's advantages in a few different places. Probably list three of them. We'll look and see if there's opportunities to maybe roll our exposure outside of a normal roll period, so to avoid the market congestion that we sometimes see with index followers. And so we're somewhat benefited by having so many index players in there that they continue to congest the market. We avoid that congestion. We'll also look across curves. We see very much valuable information in the shape of a commodity curve. I get to use some of those fun finance terms that maybe you spent a class on in undergrad, contango and backwardation.
Oh, contango's one of my favorites. Contango's one of my favorites.
Yes. I get to say that all the time in my job. And so we will look at the shape of the curves and allow our portfolio some ability to dynamically adjust its exposure across those curves in order to really accentuate some of the opportunities there. And then you can even see, if you're looking, in our case, with 24 commodities, there is some ability to maybe tilt your portfolio more towards those backwardated commodities, away from the contango type commodities. And so that's kind of really, if you were looking at our strategy today, that's what we're looking to do, is provide that enhancement through a more systematic approach that doesn't necessarily rely on me hoping that I know how El Nino is going to turn out.
Right. And certainly not. Yeah. So the research-focused, research-driven, right? That's like the philosophy, and I think that's just fantastic. Being a PhD, yes, I love that philosophy of investing. I think when we talk about equities and we talk about bonds, and if I'm training somebody to get a Series 65 or I'm training a CFP professional, that education is fairly standard, right? I can teach you what a stock is, teach you what a bond is, and take a 3 credit hour investments class, and we can get to that end. It's a pretty common end. But what education should go around or does go around or is available, from y'all's perspective on, okay, I'm a certified financial planner, I'm an investment advisor, and I think this could be a good fit in some portfolios. I want to learn a little more. Well, where would I start that journey? Any ideas on that front, or things you guys have provided as well?
Yeah, probably a few different places. I'd say for any advisor that we work with, or maybe wants to work with us. We've got a very deep bench of both professionals on our client engagement team that can help you understand that, and we can dig deeper. As well with our research people, with some specialists. As well, and eventually maybe me getting involved, and we can kind of talk through and help our advisors understand, different opportunities in the marketplace, and then specifically how Dimensional is positioned in this space. Beyond that, I think there's probably lots of great publications. I'd be a little weary of making sure that you fully understand some strategies, because, in the commodity space, I think there's a tendency to try to make it more and more complex, and tend to take all those different components that I've spoke of and try to put them into a single package. And so I'd say be willing to explore, but be skeptical of everything you're looking at.
Well, I think that's just a healthy research skepticism that we apply to any investment decision and any investment advisor. I mean, we need to make sure we know what we're doing. And in that absolutely. Space, I think there's great benefit to understanding the security before we offer the security, right? That's just kind of a basic investment advisor stuff. But we've historically seen commodities and non-stock and bond investments used in institutional portfolios, right? We've seen those in insurance company reserves and state pension funds, and the bit of illiquidity around actually physically owning the commodity is appropriate in those spaces. And so I think having a more liquid, right, the ability to get in and out of that position, does that liquidity change how y'all invest? That there's some liquidity built in to the product?
Yeah, definitely. I think, for us and the strategies that we're offering to our clients, the liquidity is definitely a very important aspect to us. And I think that's something that you get when you are entering that exchange-traded commodity space relative to, like you're saying, holding the hard asset. So I'd say for a particular client, of course, that can vary and depending on their liquidity needs and what their overall portfolio looks like. But definitely something that we're striving towards is providing that easy liquidity to commodity exposure.
Well, and I think that's important as we move away from institutional alt ownership, right? I think that that's one of the big drivers as we get to the advisor space and the affluent consumer space is the idea of saying, okay, we're used to public market securities. And when we look at things, we're kind of used to being able to get to that. And so when we make a bigger, let's say like actual farmland investment that maybe is a 10 to 20 year investment, right? Like that needs to make sure we understand that with clients. And I think that can be hard, especially someone coming from the idea that securities are liquid, like in sunlight mutual funds, for example. So I think the liquidity element of it is an important, it can't really be overstated, that allows consumers to have exposure to the asset class without the commitment that they might have if they went directly into it.
Oh yeah, it's definitely a big step that you're taking, going from a very publicly traded or exchange traded type exposure to a hard asset on the other side of that. And I know there's several vehicles and options that are maybe kind of stair-stepping in that direction, but definitely quite a shift for somebody mentally to move from buying a 40 Act fund that's invested in commodities or REITs or some other type of hard asset related type foundation to actually purchasing land and kind of then introducing all the components that come with land ownership.
Yes, very much.
And you and I both know, there's rewards on the other side of that, but there's also some headaches that I think most investors are probably not aware of, and maybe at the end of the day, really won't be able to handle.
No, and I think that's where the idea of commodity exposure with the liquidity in and out element. I mean, that's something that is very attractive, I think, for asset managers, portfolio managers to say, okay, we're going to have 5, 7, 8, 10, 12, whatever is risk appropriate for that person, but whatever percentage of that portfolio would benefit from having the diversification of commodity markets in that. And I think that allows a little more flexibility as we build out portfolios. So to me, that's a real beauty of using a more liquid tool as opposed to making a bigger commitment. So I just wanted to kind of give that perspective on what y'all do. Here's a couple of closer questions for you. When you look at your team and technology, so do you have one analyst per sector? I mean, is it kind of a group effort? Like how then does the magic come to be when you look at it from a team standpoint?
Yeah, I think for us at Dimensional specifically, it's probably stepping back again, kind of looking at it. It really starts with the research for us. And so we have a very strong research department that we've built out. They're not only looking, out at the academic papers out in the marketplace, but they're also looking internally, retesting, trying to understand how we could implement. Right. Oh, yes. Lots of data. So I remember when we were first launching the Commodities, speaking of the data, we were wanting to try to get back as far back through history as we could. And I remember finding somebody online that offered up a CD that offered grain data back into the 1970s. And so we purchased that online and purchased the data, and so was an important, not a crazy important piece, but a kind of helpful piece to help us as we were starting to do that research and build out more and more data to understand what we were going to do there. But I'd say our research is really the component that starts all those processes. After that, as it moves to the PM and trading teams, it becomes more about implementation. And so we're a little bit more generalist. We don't necessarily have analysts or portfolio managers that are focusing only on a particular component of the market or a subcomponent of the market, but a little bit more generalist. We find that gives us a little bit more flexibility to adapt, to change through time, and really to leverage what we know and what we learn of maybe in the bond market. We can apply some of that to the commodity markets and vice versa. So it's makes us a little bit sharper across the board. And so we'll take that. And, I think an important part for us is also the implementation. And so, we could have a great research idea that's very cost prohibitive to implement in the portfolios. And so we want to make sure that we're keeping, transaction cost, any other type of cost as low as we can as we implement that, and that that doesn't eat up maybe some sort of expected premium that we believe we can get in the market.
Well, I absolutely love that answer, and I love the research focus of Dimensional. I think that objectivity is a core pillar, and a lot of strength of relationships with advisors comes from that ability to have that objective research, and you see that when people talk about Dimensional as well. The reputation is very strong to that end. So I want to thank you, Alan, for coming on today. This was a fantastic conversation around commodity markets, and I think it'll help our listeners and advisors and consumers alike.
Well, thank you very much. And I've subscribed to the podcast. I've listened to every episode and look forward to hearing many more to go. So great thing you're doing here for the agricultural community.
Well, thank you, Alan. We appreciate having you.